You're listening to the Money Insights Podcast, where wealth builders come to think bigger, invest with purpose, and design a life of freedom and impact. This is where elevated thinking meets real-world opportunity. Let's dive in.
Welcome into today's episode of the Money Insights Podcast. I'm your host, Christian Allen, and with me today are two familiar faces. We have Brenyn Babyface McConnell and Blake Never Takes a Break Brogan. Rod's out this week. Hopefully he's having fun. I think he's connecting with one of his sons that's going to be deployed, and so they're taking some time to spend with the family. So good luck to Rod. But today we've got a killer topic. But first, guys, you excited to be on today? And I appreciate you guys coming on. So welcome.
Super excited. Glad to be here. Excited about the topic, and it should be fun.
Yeah, we have a fun topic. We have a spicy topic. Spicy topic. That's what we're going to go with. Okay, so today, our index universal life insurance policy is dangerous, the good, the bad, and the ugly. Okay, so we're going to break it all down. Now, I should just set the table here because this topic was inspired by a few recent events. Number one, I read the story about Kyle Busch. Did you guys hear, read, and see that story?
I did.
Okay, we can talk a little bit about it. Does anyone want to break down, just kind of give an overview of what happened in the Kyle Busch story? Do you guys remember well enough?
I can give a
give us the gist, Brenyn.
So the gist of it is Kyle Busch got into an index universal life policy on the recommendation of one of his financial advisors. And it ended up being high level, overpromised and under-delivered in a major way. And what it seemed like is pretty blatant misrepresentations on the advisor's part, along with poorly designed policy structure. And there was yearly updates. Like I feel bad for Kyle because he was getting annual updates and everything from his advisor was like, yeah, it's doing good. Just send in more money. And it ended up blowing up. Kyle Busch lost a bunch of money and now he's going after trying to recoup the money.
Yeah. Okay. So what I read, and that's pretty similar to what I read, but basically he had put in something close to $10 million into the policy over, a period of like 10 years, something like that. And he found out after he was going to stop funding it after those 10 years, that if he didn't continue to fund it, it would lapse in like 16 months or something like that. So when we see that, we know exactly what's happened, right? We're like, okay, that's clearly a design issue, but general public isn't going to know that. So today we're going to like break down some of the things that are, because there's obviously real concerns that I have to be aware of when I'm using, especially universal life insurance in comparison to whole life. It's not that one is necessarily better than the other, but they have to be used the right way. So we're gonna kind of break that down. But that one, kind of put this idea on the map that, wow, our IULs like just this terrible thing. And the reality is, and we're going to get to this, the reality is that there are things that have to happen. You have to do it right. If it's done right, it absolutely works. And if it's not done right, it can be a real disaster. And that's kind of Kyle Busch story showed us. Okay. The other thing is I got an email. Well, actually it was Rod that got an email, and I won't tell the name because I don't have permission from the emailer, but the emailer basically said, I listened to a recent pod. We did, if you guys remember, a couple weeks ago, we did the new ACS pod, Accelerated Capital Strategy pod. So just kind of our new framework of what was previously the capital avalanche concept. And in his email, he said something like, oh, I like this new idea. It's really intriguing, but I don't really like IUL, so I have to be out on it, right? And his reasons were increasing costs over time, right? And just some of the negative stuff that he had heard out there that kind of scared him, made him fear that, okay, this could go wrong. And so that kind of made me feel like, well, first of all, it did one thing for me. It made me empathize with that person because I had my own experience, and anybody who's been listening to the pod for a long time probably remembers this, but when I was early in the business, I inherited, I thought it was a good thing at the time. It wasn't good, and it wasn't profitable either, by the way, but I inherited a book of business, and it was basically all universal life at that time. Well, okay, I shouldn't say that. The agent that I inherited it from wasn't in the IUL phase, right? IULs came a little bit later. So he was writing traditional universal life, which is the same chassis. There's just a different growth mechanism in the IUL, which we'll talk about. Well, it's through participation in market, like not the actual market. We'll get into that stuff. But it's basically one's built based on fixed interest rates and the other one's based on more upside because it's tied to the market. Okay. So the mechanism inside of those, or the chassis, that's probably a better way to say it, is really the same either way, right? So it all has to work the same way. Basically there's more flexibility than you get in whole life, and so you have to make sure that they're funded well enough so that they'll run and that they can withstand potential cost increases or whatever they're happening. And so the problem is that I inherited this book of business, and it was a bunch of dying universal life insurance policies. Like, I remember on the actual statements that we would get from the insurance company, it would go out to the person, and then they would like highlight at the bottom. It would say, if you continue to fund at XYZ premium, this will go till this date. And what happened is people started realizing that it was like, it will go till 71, or it will go like, and these are people who are like 68 years old, right? And so what's happening now is, because of the funding structure that they were having, not putting enough money into them up front and thinking that interest rates were just going to carry them, those policies were an absolute disaster. Okay, what's my point? My point isn't to beat up on universal life. My point is to empathize and just say, like, the issues that people have, or that people could have with universal life, are real and deserved because of some of the challenges within the industry over the years. We had to learn some things the hard way, and we could get into what those things are, but I the main thing that I want to emphasize here is just that I feel that same pain. Now, I also took the time to learn, understand, and like really devour this stuff, because I vowed at that time I would never sell universal life insurance. I was going to sell whole life, term, and that's it, right? And I actually stuck to that for many years, until I took the necessary time to actually understand like the dynamics that were happening underneath. And really it was like, I was so closed off to it that I couldn't even get myself to do it. But once I did, things changed a little bit for me. So what we're going to do today is we're going to kind of break it down to talk about the good, the bad, and the ugly. So I think the place to kick things off is for us to describe the basics of what an IUL is. I know most people listening to this will already understand what an IUL is, but Blake, give us kind of just a quick overview of what an IUL is and kind of how it works.
Yeah, IUL is one. Yeah, we have the universal life chassis. So basically, in permanent life insurance, you either have a universal life chassis or a whole life chassis. Universal life can be the basic one, which Christian, you just talked about. You can have an index universal life. You can have a variable universal life. The main concept with the indexed universal life is that they're going to take the interest that you would earn in that policy, and they're going to tie it basically by options and tie it to some sort of index, most typically the S&P. And that index is going to then provide you a cap and a floor. So for example, your cash value might grow in that year. Let's say the S&P gets a 20% return in that year. Maybe your cap is at 10%. So you would earn a 10% growth in that year. You would then, maybe the S&P goes up 7, you would earn a 7. If the S&P goes down 20%, you're going to get a 0 in that year. So that's a pretty simplistic way, but basically you're using an index like the S&P as a measuring stick to get somewhere between a floor and the cap. Now, to your point though, Christian, that's kind of just a basic, and then how you design that policy will very much dramatically impact how the cash value grows. So
yeah, for sure.
I'll leave it
For
at that.
sure. Yeah. Okay. So the big difference is, I mean, when we're talking about whole life, like whole life has like the guarantees. It's like super safe. You kind of know what you're going to get from it. IUL has more upside potential because it's tied to the market indexes, like you talked about. To your point, regardless, they have to be designed correctly. We'll talk about the design here in just a few minutes. But before we get more into those details, I'm just curious because I don't know if we talked about this, and you guys are obviously quite a bit younger than I am, but what's your experience like dealing with universal life? Have you had, like, I don't know if you guys had the kinds of experiences where you, or did you come in with biases one way or the other, and kind of where do those sit today?
I actually did. So I had my grandfather, my father, uncles have been in the insurance world predating, many decades ago. And I did get a chance to look at a lot of, as you described, Christian, just standard universal life. From my understanding, in the 80s, when interest rates really soared, these universal life contracts, you look at the original illustrations, look great. We have interest rates in the teens, 13, 16, 18%. And I think the idea was, hey, most of those universal life products were bought for a permanent death benefit. Not a lot of as many of the strategies that we're teaching today, where we're using the cash value for other investments.
Yeah, I think that's an important point, Blake. Just to emphasize that one more time. So typically the universal life contracts that we're seeing in the past that are kind of dying were built not to maximize cash value.
Correct.
They were built for death benefit. And the person typically knew that going in. Like that wasn't their goal, right? Okay.
Yeah. So I'm and just looking at it, I can envision what the conversations were like. Hey, if you were to term cost this, but you're going to outlive that, right? So if you want a permanent death benefit, let's say you wanted $1 million of permanent death benefit. Well, we can either do that through universal life or whole life. And with the interest rate environment being where it was in the late 80s, early 90s, the premium dollars that you could fund into a universal life for the same death benefit amount that you would get in whole life was dramatically lower. So a lot less money out of pocket to be able to get this permanent death benefit. Now, part of those,
why was that, Blake?
Well, because we were getting an interest rate, in those where dividends and the guaranteed interest works a little bit differently in whole life. So
maybe, maybe just kind of a helpful point here. Whole life had at that time a much lower end result, right? Like the actual dividend and interest weren't nearly as high in that time as these crazy soaring interest rates. And so the idea was, well, why pay the premium that I have to pay for a whole life policy when I can pay much less and get the same death benefit with this universal life, because it's earning 10 or 12% instead of earning 8%, for example.
Exactly right. So then on these projections, they would build them quote unquote conservative and assume a 12% interest rate, right? Which is crazy in our lifetime, or in my adult lifetime, to think that was a quote unquote conservative, because we would be
nobody
just
would
in a whole
do that.
different world.
It would be totally unethical for people to put that out there today based on, but again, interest rates at that time were very, very different, right? You were buying houses at 14%, that kind of stuff.
Yeah. And I even remember my grandpa telling me he bought, the first house he bought was at an 18% interest rate, and he thought he got a good deal. Right. So this is just a whole different world.
Just don't forget that it was only like $10,000 that he spent from that house.
Exactly. And I paid it off in 2 years, Okay.
Right.
Yeah. It's like, all right, different world. Anyway, so with these policies, what they would show is, hey, if you fund this for 10 years or fund this for 15 years or whatever the number was, we're going to have so much growth inside the cash value that it will continue this death benefit, well past your life expectancy, typically to age 100 is how they would run it. Well, in reality, what happened, those illustrations those policies get sold. And then steadily over the last 40 years, we've had a ever decreasing interest rate environment, which means that the cash value isn't growing as effectively. And then the second big piece that happens there, because the cash value is not growing as effectively, when insurance companies are charging their costs, they're charging what they would call the net amount at risk, meaning the difference between what the cash value is and what the death benefit is. So if the cash value is not performing, you also have, a higher gap between the death benefit and the cash value, which means costs are increasing overtime in that as well. So that's where we got into a lot of the scenarios where you said, Christian, where someone maybe funded this for 10 years, didn't really monitor it. They're like, hey, I was only going to fund it for a certain amount of time and it was going to run till age 100. Well, in reality, as interest rates changed, cash value didn't grow as effectively. And now they're running to age 78 or 83. And then you get these older individuals who, get notices in the mail like, hey, you need to put a lot more money into this thing when they hadn't been
and it's
funding it for a
heartbreaking
long
when
time.
that happens.
Totally.
And
it's terrible.
people have been putting in money for years and years only to have the very real possibility of it lapsing.
Without question.
And that's where the universal life chassis got its bad name. And, again, to be fair, it was probably deserved based on what was happening at the time. Now, I don't think it's malicious, right? Like, I don't think most of the time agents were thinking, how can I go out and sell this? I think what was happening is they were selling based on what they thought was happening at the time. They hadn't learned the lesson, like the vital, critical lesson that needs to be learned around universal life policies, and that's that design matters. So they just relied on the combination of this new cool product for them, right? Because whole life had been out for a long time. Whole life and term, where your whole life was first, term comes second, universal life comes third. And the whole idea is that this is just a better option. I have more flexibility. I don't have to pay as much premium and I get the same kind of death benefit. Well, if that's the reality, if interest rates had stayed higher and universal life had outpaced whole life over those years, then the result actually would have worked, right? The problem is it didn't. And to your point, as interest rates went down, cash value grew less, net amount of risk was higher than expected, and now the policies aren't running and performing the way that anyone expects them to, and a lot of people are just like furious about it. And again, reasonably. Okay, so when I got that email, it just made me empathize with the people who feel that, because I have lived that experience, and again, I for a long time made that like vow that I just was never going to do it. Okay, well, guess what? Come 2026, we sell index universal life policies today. Well, the question I think is, how did we come around to that point? That's what we're going to get to. Okay, so let's talk about the good stuff then, because again, like so far we've kind of emphasized the negative, but I think it's really important as people are listening to just realize that the reason the negative exists, like there are very real reasons that why those things exist, but there's also very real solutions to those challenges. So we're going to make sure that we talk about the good stuff first. Okay, so when you guys think about index universal life, what comes to your mind as kind of the positive elements of index universal life, and why?
So this was the very first permanent life insurance policy I ever bought was an index universal life policy. But that's because I didn't understand whole life either at the time, right? So here's how it was framed to me. So you had index universal life, you had whole life. Index universal life had downside protection, but you could also get like 9, 10, 11, 12% returns with that cap. And on average, if you run that out, the last 30 years, the average return was sitting at like 6 to 7%, something like that.
Yeah.
Whole life was earning at the time around 5.5%. And so, I'm 23 years old. I'm looking between the two and I'm like, man, I got
a long time to go.
Right? So I was looking at, and again, this is before I even thought about borrowing from the policy. I knew that was a possibility and, a benefit, but I didn't fully understand investment optimizer and, hey, you can pull this money out, invest it in alternative assets and really, create velocity, momentum. So I was more looking at it purely as like retirement income, right? And I was looking at it saying, hey, how much money can I accumulate in these policies with my $3,000 that I was looking to put in at 23 years old? And I ran the numbers and I looked at whole life versus IUL and I was like, man, if it's 45 years from now and I'm 65 years old, this extra 0.5 to 1% is really going to make a difference for me. Right. And so I was like, yeah, I'm going to do IUL. And again, it was $3,000. The illustration was showing $3,000 a year until I'm 65. And then at 66 years old, I'm going to be able to pull $74,000 of tax-free income, which again, at 23, I'm like, 74.
Money in the bank. I could live off that forever.
Yeah. Do I even need a 401k?
Right. None of that stuff, right?
Yeah.
You're good to go.
I looked at that and I was like, hey, retirement planning, guaranteed 74,000 a year. You know, I'm going to be able to put 3,000 a year into it for the next 45 years. I can make that happen. And so in my opinion, 74,000 of tax-free income, I thought was a pretty dang good value add to a retirement portfolio. And so I thought, hey, that's a no-brainer. In addition to that, the other thing that I was looking at the time was what people call a volatility buffer, which is just basically it's a non-correlated asset. So something that doesn't correlate with the stock market, where if my stocks were down for the year when I did retire, I had this big bucket of money that I could pull all of my income from, and that my retirement accounts, my brokerage accounts recover, which would therefore extend the life of all of my accounts, right? So it helps basically, it helps guarantee that you'll always have money in retirement, or it's supposed to guarantee that. So those were a couple of things that I looked at and I said, okay, IUL, you know, I think that's a great value add, a great option, and a good reason for people to say, hey, I think this can make sense.
Yeah, absolutely. Okay, so you're saying just the real long-term potential to create income could be a value add. And to your point, if IUL over the next 30, 40 years outpaces whole life by even 0.5% or 1%, it does have a it has a significant difference in terms of how they run, right? And like what I can actually get out of it. Okay, that's good. I like it. And I think that's real. Retirement income is obviously a big part of why we use it, right? We believe
Right.
that it can be used again, and we'll get into the design stuff because I want to make sure we overcome kind of the core objections that people might have around this stuff. But I wanted to make sure that we hit on the good stuff. So I think the good is just that it genuinely can provide a higher overall return than what I can get. Again, I have to say it because we don't know that it will, but it absolutely could if designed correctly. I say correctly. I don't like that wording because like the design of life insurance depends on what you want the actual policy to do. But if it's designed for high cash value in both cases, it can very much do exactly what we're saying and very well could outpace whole life and be something that creates significantly greater long-term income. A couple of other things that I think are good about it. And I didn't always think this, but I'm going to talk about a few of them. One of them is flexibility, right? Now, the challenge is that people don't realize that whole life basically has the same flexibility with it, right? If you're funding the way that we do. So I'm going to take a step back for a second and talk about the whole design element, because for a lot of people, this is really abstract. People don't necessarily realize that life insurance is cash value. Life insurance is very much designed based on the agent advisor that a person's working with. They're going to be the one that comes back, and they actually have a lot of autonomy to determine like some of the actual economics that exist within the policy. And it primarily exists because they're reducing the amount of cost. Well, the way you reduce cost is you reduce death benefit, right? So in every situation for us, we're taking the minimum death benefit and the maximum cash in it so that, Blake, as you mentioned earlier, we have this net amount at risk, the cost element, we want to keep that as low as we possibly can. Okay, I'm totally getting off track here. I don't even remember what my point was.
I think a good point you're making there, Christian, too, is the autonomy to structure the policy is all of the agents. But in addition to that, that also determines the compensation that the agent makes. And so I think a point to bring up is depending on how the policy's been structured, and I think most people know this, that compensation that the agent is going to receive is completely dependent upon how that policy is built. The more death benefit, the higher the cost, the bigger the compensation. The lower the death benefit, the lower the cost, the lower compensation. And so I think the other thing with agents or advisors that, you know, are just getting started or maybe don't do as much volume as a group like us, Money Insights, is, you know, you can kind of determine how much compensation you can receive. And so, you know, with us, it's just a given. We're reducing the death benefit, we're reducing those costs as much as we can. But some agents don't do that.
I want to add to that, because I think a lot of times if you talk about someone who's maybe a more holistic financial advisor that is a believer in permanent life insurance for XYZ reasons, to your point, Brennan, they also may not know exactly how to design the policies for optimal cash value, right? Because sometimes just the software illustrations, if you're not in that every day, if that's not what you're doing and you know how to run those.
Well, I would say it's frequent. Like it's pretty
Yeah.
typical that most advisors, if you're kind of in that traditional financial planning world, you're not designing the policies the way that we do. I've rarely seen it. In fact, and part of the reason I know that is because when we have people look over it, they come and ask us all these questions, and I look and I'm kind of like, this is like so basic, guys. Like, how do you not know this as a, I know I'm going to throw the CFPs under the bus again, but how do we not know like the core bit? Anyway, okay, but we are getting off topic because we're gonna circle back to this design thing. Every time I try to explain something, I feel like, oh, I have to make sure that this caveat exists because there's just like layers as to what's going on here. But I want to make sure that we actually circle back and hit on the things that we view as positives. You talked about retirement income. I was trying to say that flexibility is positive. Now, flexibility can be good or bad. It can hang us, but if we use it appropriately, it can absolutely be really powerful, right? It's kind of like the principle of leverage, right? Leverage can be good or bad. It is neither good or bad. It depends on how we use it. So similarly, that flexibility can be a really powerful thing if we're strategic and intentional in how we're using it. So the higher upside, right? We've talked about higher retirement income, but if I just want more cash over the long term, like there's the possibility that there's more cash. And because of that, there's the possibility that there's more death benefit. So the biggest upside to Index Universal Life, from my perspective, is just that there's upside potential above and beyond what I could get from whole life, while at the same time cutting off the downside, right? And that's an important element. Now, I'm going to clarify this because we're digging into the weeds here. When I say cutting off the downside, what I mean is that the policy cannot have a year where the cash value goes lower. It reduces due specifically to the market performance. Now, just to be clear, because it drives me nuts when people don't make sure that this is really clear. I could have reduction in my overall cash value if and when the market's low and I have cost on top of it, right? So it's specifically the part that I get protection on is typically that the cash value is not going to go lower based on what's happening in the market. So, but long story short is that's still powerful. And I personally, by the way, I own whole life. I own Indexed Universal Life. I own term insurance. I own each of them for very different reasons, and they all have a really important place in my overall financial strategy. So just from hey, do these guys believe what they're talking about? After Rod and I really did a deep dive into IUL and felt like we got to the point where we could understand what the mechanics of the contract, the policy were that would make it go and do the things that we wanted it to do. Once we understood that, we bought in ourselves. So we put $300,000 into the ACS. This is probably 4 years ago. And I've always been a believer in whole life because that's obviously the core. That's what we use the investment optimizer in conjunction with. So anyway, from a belief standpoint, I think and Brennan, is it fair to say you own both? I don't know about Blake. You might be an all whole life guy, Blake.
I'm a whole life in term at this point, but it's just, again, it's because of what I'm looking to do
timing,
with it.
Considerations, right? All those different things. Not necessarily a belief factor, but just to your point. Well, Blake, you came on with us, what, 5 years ago? Has it been 5 years-ish?
Yeah.
Yeah. And you came from a place where it was like all whole life and term, and you're using classic mutual companies. And so I totally get it. Oh, I have another one. It works better because of the loan structure, because of the underlying mechanics. It works better with premium finance. And this was one of the important elements. So part of the reason that we implemented IUL is because it is really difficult to create a spread when we're using whole life insurance for premium financing, right? Whereas because of the back end mechanics or what are of what are happening inside of the IUL, it becomes more feasible to create the spread that we need over the long period of time that we talk about for the ACS strategy. So, okay, so those are all really important, good things, but now we're going to hit on the bad and the ugly. But we're going to make sure that we explain kind of what's happening in the background. If, some of it we've already explained, but we'll go into whatever we need to. So as we get into our bad stuff, I'm just going to list them out. Illustrations can be overly optimistic. Okay, Blake, talk about that.
Well, I was even meeting with someone a couple of weeks ago, and they were showing me old IUL designs that they had from, these are policies that are currently in force. They're working well, but looking at they were a lot, the performance of the policies was a lot worse than what they projected, even though I would say the policy was still in good shape. It was set up well. But they were basically, the agents were basically at that time projecting as if you were going to hit the cap every single year, right? So they had caps of 10, but they were projecting nearly a 9% return in the policy. That being said, it's my understanding, because this kind of predates my time in the industry, that there has been some laws that have changed in terms of how people can illustrate.
AG 49.
Yes, dating back a few years ago where these came in, where it didn't at all change the products. It just changed the way that the illustration softwares would be able to project. And so now, even though the design may be the exact same, I think the projections that we can run are much more realistic, to Brennan's point, maybe in the 6 to 6.5% return, as opposed to the 9% return, basically assuming the market's going to go up and have good performance very regularly.
Are you someone who's interested in alternative investment strategies? If so, make sure to join our Investment Insider series to get exclusive behind-the-scenes access. We created the Investment Insider series, IIS, to give you access to experienced operators, real investment conversations, and pressure-free education around how these opportunities actually work. You can join at www.moneyinsightsgroup.com/insider access. Back to the episode.
Yeah, and that's crazy, right? It's crazy to think that if I've got a 10% cap, I'm going to capture that much of it year in and year out. So what it looks like in reality for us is, this is what's interesting. A lot of people don't realize this. When we're projecting whole life versus IUL, like I think our IUL projected rate is like 0.5% to 1% more than whole life, right? It's not significant. And that's because we're taking into account historical performance and saying, okay, if over a typical 10-year period, I'm going to hit the cap 6 or 7 times or 8, somewhere 6 to 8 times, and I'm going to have 3 or 4 times that I end up getting a 0. Well, what's the net of that going to be? So the good news is the industry has been forced to be more realistic about what those, what the actual illustration can show. So we're not, now, by the way, this happened in whole life too. I remember when I first got into the industry, and this might still happen, I don't even know, but when we would go and be in competition with Northwestern Mutual, they were projecting significantly higher interest rates than any other company, and they weren't hitting them, by the way. So that was happening inside of whole life. It was like projecting like an 8 or 9%. Now, this has been 15 years, so this probably before you guys were seeing like those higher. Let me try that again. So long and short of it is illustrations can absolutely be overly optimistic. The good news is that has changed to where it's less likely to be overly optimistic. They're going to be pretty realistic based on the rules and laws that have been put in force for us today. So that's the good news. I was just going to say the design has a lot to do with the actual illustration and what kind of performance we get it. So for example, when we're using a whole life contract, we're going to show, like, if we're showing one that's base premium funded, which means it's, there of that premium, there's a portion that's going to pay for the death benefit, and there's a portion that's going to cash value. We're projecting like an IRR on that over a long period of time of like, 2 or 3%, right? Because there's nothing creating additional return. So what ends up happening is that once I put in the extra money, I suddenly have the chance to kind of create this extra this extra opportunity that comes in it. So the reason I say that is because that the design is different than what we're suggesting here, where just any illustration can be overly optimistic. We're not in a place where people are going to be showing a 12% index universal life contract. Period. End of story. If they are, they're not working with any legitimate insurance companies. Okay, so we don't have to worry too much about the illustrations, other than making sure that we understand that based on the design element, there could be something to that. Okay, caps and participation rates may change. This is one I've heard a lot of times over the years, and honestly, it's one that I had a lot of concern with, because the concern is, well, what if I get into a policy right now when the cap's 10%, and 2 years go by and all of a sudden they've lowered the cap to 6%? Okay, so who wants to talk about kind of caps and help people understand what's going on with caps and why that's a concern, or why not?
I can jump in on this, and then you guys can add anything that you want to.
Perfect.
We've seen caps change, and it's not a shock that caps will change. And I think the biggest driver of that is interest rates, similar to how interest rates might affect insurance or whole life policy dividends. And so when interest rates are higher, the insurance companies are able to be more profitable themselves, which allows their whole life dividends to gradually increase. Again, you're not going to see dramatic spikes in dividends or decreases in dividends. And I think you can pretty much expect the same on the IUL side, where you're not going to see dramatic increases or decreases in the cap rates. But you will see subtle changes. So as the insurance company is profitable, more profitable or less profitable, you're going to see those cap rates change up or down. And that typically has to do with interest rates, because that's how the insurance company is earning money themselves.
Yeah, and it has to do with the budget that exists to go out and buy the options that they're buying to create the underlying spread, right? So if the options are more expensive, I can't pass on the same kind of return but to your point, that's based on what's happening in our interest rate environment. That's having the kind of an impact on the budget that I can use to actually go out and purchase options. So caps and rates do change, right? But here's the big concern that people have. They think caps are could just go down. A company could lure me in with a higher cap and then just lower it on that book of business later. So I'm curious, and I'm just throwing it out there. I have an answer to this, but do you guys have any thoughts on why a company may or may not do that? Or maybe a better way to say it is, I don't think that that's like how the companies are going to work, right? And I'll explain why. There's some logical reasons why, but do you guys have any thoughts on just the motivation of the insurance company to either increase or decrease caps?
Well, a big part of it is that these insurance companies are in competition with each other, right? So when we're talking to individuals and we're trying to set them up with the best policies, we're looking at all the different companies, all the different policy designs, and you see it in the literature coming from the insurance companies of like, hey, here's how we stack up in certain situations against other carriers. So if a company is getting a reputation of, hey, we're on a certain book of business, we're consistently cutting the cap rates, just in, basically demonstrating higher ones early on and then cutting those, that's a way to basically make sure you're killing your business moving forward, because agents aren't going to trust what you have going forward.
Yeah, I think that's a huge one, right? So we have to be like considering the underlying economics and motivations of the companies. And so I believe, and the good news is we've seen this. So I've been around long enough to see interest rates or to see caps go down. I've also seen caps go back up. Mm-hmm. Right. And I think that's the big concern that people have is like, okay, I get that they can go down, but are they just going to keep them there? To your point, that's a great way to lose a book of business and to, basically put your company into the toilet if you were to develop that kind of reputation. The other thing is that life insurance can be moved. Cash values can be moved. And when companies start to do that, people are just going to take their business and go somewhere else. Right. So now one of the challenges obviously is that universal life often comes with surrender charges, and that can be kind of painful, but But even in spite of that, they would still, by not being competitive with the marketplace, that's going to be a much bigger killer than trying to get a few extra bucks from lowering caps. Do you know what I mean? Like, they're going to win more over the long run by being competitive in the marketplace than they are by trying to cut caps and run type of thing. And the good news is we haven't seen. Now, I will say this: companies that are in trouble are maybe more likely to do it. I've seen companies in the past that if they end up in genuine financial trouble, then that kind of thing can take place, and it oftentimes does, right? Or if a company's like struggling and they end up selling it off, then oftentimes you're no longer getting the optimal result. Now, the good news is, there still are parameters that these insurance companies have to work within, and within the contract, it'll give you some of those parameters. But if you're, so I guess the lesson on that one is make sure that you're also working with a strong a good reputational company that has a long track record of success and been doing it for 100 years, and you'll feel a lot better about it.
And I just want to, can I throw in one thing there? Because I mean,
yes.
Even next week we're hosting our IWB webinar series talking about the options that you have. If you have a current life insurance policy, it's maybe either not the structure that you want at this point in life, or it's been underperforming. There's options using what are called 1035 exchanges to move that cash value into other products. So that's something that we're talking about. We often work with clients and take a look at their situation and say, hey, are there optimal ways that we can use this cash value moving forward? So that's, something that we're doing on a regular basis in our practice. And,
yeah. And that's a good plug, Blake, because this pod will come out before the IWB webinar, which I think is happening on the 17th. And this will come out a few days before that. So if you're listening to this and you want to dig into the whole 1035 exchange world, we're going to be breaking down 1031 and 1035 exchanges in our IWB live webinar that's on Thursday, the 17th. Okay. So we talked about illustrations. We've talked about caps. Let's talk about internal costs. Now, one of the things that the emailer that I mentioned early in our show, he said to Rod, I don't like Index Universal Life because costs rise as we get older. And I'm just going to throw that out to you guys because I'm curious how you might respond to someone saying, "Okay, I'm not a fan of this because the costs get higher as we get older." Thoughts?
Yeah, I'll jump in on that. So it's true, costs do rise as they get older. However, in a properly designed policy that is structured for high cash value, again, back to Blake's point, it's the net amount at risk that you're being charged for. And so if you've ever looked at a whole life policy or an index universal life policy and gone to the very bottom of the illustration or the current ledger, it goes to age 121, typically age 120, 121. And at age 121, your cash value is going to equal your death benefit. So if it's a $15 million death benefit, because those get pretty big once you get that old. If it's a $15 million death benefit, your cash value is $15 million. And what will happen is over time, as you get older, your cash value is going to get a little bit closer to that death benefit every year you get older, at least in a properly designed high cash value policy. And so at the beginning, if you're 45 years old and you put in $100,000, you've got a $2 million death benefit and $80,000 of cash value. Your net amount at risk is basically $1.9 million. Well, at the age of 70, you might have a $2.5 million death or cash value and a $4.4 or $4.3 million death benefit. And so your net amount at risk is now 1.6 or 1.7. And then at 80, your net amount at risk is only 1 million. And then at 90, your net amount at risk is only 600,000. And so, yes, the cost of insurance is increasing, but so is your cash value. And the your cost of insurance is increasing, but the amount of insurance you're paying for is decreasing.
That's absolutely true.
Yeah. And
Sorry,
I was
I
just
didn't
going to
mean
say,
to
it
cut you
actually
off.
works pretty similar in whole life policies.
Yeah.
It's a
Okay,
little bit,
that's great. So here, the thing that stood out to me when I read that email was that he was specifically highlighting universal life. But I just want to take a step back here and make sure everyone realizes that life insurance costs increase regardless of what type of policy I have. It doesn't
Mhm.
matter whether it's term, whole life, or index universal life. Like, it doesn't matter. All life insurance gets more expensive because really all life insurance is 1 year renewable term banded off into groups. So when I have a 20-year, it's 1 year renewable term, but I've evened it out over a 20-year time frame. The same thing's happening inside of whole life and universal life. The difference, and this is an important difference to the emailer's credit, they're still seeing something that's important. The difference is that whole life says if you pay XYZ premium, we guarantee both the cash value and the death benefit. And that is different, right? That's very different. Whereas on the universal life side, they're saying, because we're not requiring that at least this minimum premium, we're going to give more flexibility. We're also not going to be guaranteeing that this result necessarily happens forever. And again, we're going to get into design here in a second, but I just want to make sure that people understand that all life insurance costs get more expensive as we get older, because that's the nature of the way that an insurance company has to price something as we get older. It's just the nature of how it works. All life insurance is that way. I think that's super critical. But again, big difference. One has a guarantee around it. The other one typically doesn't, although you can get some guarantees even in the IUL world. Okay, so now we're starting to get into the design element, but policies can struggle, can blow up. So let's go back to the Kyle Busch story, right? So Kyle Busch buys a policy. He puts $10 million into it over 10 years. All of a sudden, he gets a letter in the mail from the insurance company. It's crazy that insurance companies are still sending mail, by the way. But that's probably what happened. He gets the letter in the mail and he's like, wait a minute, I put $10 million into this. How could it be potentially blowing up? What's the word I'm looking for that? I'm not blowing up. Lapsing. Thanks. It could be lapsing in 16 months from now. Okay, so we know exactly what happens. That was like the tell, even from a distance, right? Just knowing the life insurance space well enough, we could look at that really quickly and say, okay, what happened there was the agent designed this policy for maximum death benefit, minimum premium, which meant that the death benefit for Kyle Busch's policy, I have no idea what it was, but it was probably 50 million, right? It was probably a really significant death benefit. And so most of the money that's going for that is paying insurance costs. Whereas when it's designed like we talk about for this high cash value, it's really designed exactly like a whole life policy. So if you think about whole life, they require that additional premium up front so that the policy runs indefinitely. It runs for the rest of your life. Well, IUL doesn't require it, but guess what? The mechanisms are exactly the same in the sense that I can put just as much money into a universal life contract, and the difference is terminology, right? With whole life, I have a base premium and paid up additions. With universal life, I usually have a target premium. And then, there's like, they basically give you different benchmarks of premium, right? Where it's like, hey, this is the minimum level, here's the target. And then there's the level that we go to, which is the max funded level. And so what ends up happening then is if I'm funding it, if my policy is max funded, in both cases, they're actually running very much the same, right? They're designed in a way that they're loaded with way more premium than they actually need in order to run. So I always tell people this on the whole life side, like when we put one premium in, we're putting like 4 or 5 years of required premiums in. So suddenly we do that 2 or 3 or 4 years and we've put 20 years worth of premium in the first 3 or 4 years. Well, suddenly the policy has all sorts of flexibility and freedom that goes with it. The same exists inside of your IUL, right? This exact same principle. The difference being that the insurance company has not put guarantees around it. So you have to do some other things. You have to be more intentional monitoring it and that kind of stuff. Okay. So we talked about illustrations, caps, costs. The point on this one was that if I don't do that, right? So if I don't do the overfund thing, that's when I end up in a situation like what Kyle Busch ended up in. And that's 99% of the people that I've talked to who are unhappy with their policies. It's for that reason. It's because they look at it and they think, hey, it should have been doing this and it's not. And it's because it was not funded for the intention that they wanted it. So again, if my goal is cash value, I've got to fund it so that it creates cash value. My goal is death benefit, I've got to fund it so that it at least supports the death benefit. Okay. Complexity. Well, this is kind of an obvious one. So I'll say this though, all life insurance is a little bit complex, right? I shouldn't say everything outside of term insurance is a little bit complex, but what comes to mind? What's your guys' experience been with just the issue of complexity around IUL? And would you say that IUL is more or less or about the same in terms of complexity to what whole life looks like?
I would say it's fairly similar to whole life with the caveat of the index options that you can allocate your premium to. So, and I also think, we typically just recommend the S&P 500 as the index option. That just makes it so easy to follow. It's very clear. It's also super consistent. We know what it's been doing for the last few decades. Like it's just, we feel the best about using that option inside of an index universal life policy. There's some things called dynamic indexes that some companies use. Those can be super confusing, especially because, and this can be a little bit misleading for people, sometimes those dynamic indexes will illustrate better than the S&P 500, but they don't necessarily actually perform better. And so to maybe a quick overview of what a dynamic index is, they basically take a few different triggers and a few different stocks and however they make up the index, the dynamic index. And then they say, hey, if these things were all the case and all these triggers were set over the last 30 years, this is what the index would have done. But it didn't actually do that. They're just looking back and saying, this wasn't actually created, but if it was created, this is what it would have done. And so it can look really good, but it doesn't necessarily mean that it's going to continue to perform that well. And I think in most cases, when we look at dynamic indexes and the actual performance in those, they don't look great. It's also confusing, right? Because again, it's not something that's actually been around. They're just taking something and saying, hey, if this would have been the case over the last 30 years, this is what it would have done.
Yeah. So basically what you're saying is once you get into the crediting methodologies from the different companies, they can get creative, and sometimes that can create an additional level of complexity that maybe isn't always necessary and can just easily confuse people. I think that's a fair statement. And by the way, life insurance companies love to do this. They've been doing it forever. I remember early on when I started and I would, be competing with different insurance companies. And so I feel like I'm really beating up on Northwestern today, but they had I don't know if I've even seen it since, but they had a variable whole life policy. That's right. A variable whole life policy. And in my mind, I just thought like, we're just trying too hard here now, right? We're just getting a little too crazy. Like the whole point of whole life is supposed to be this, and now we're adding this, and it just didn't make any sense to me. But so I think life insurance companies have had a tendency to do that. And let's face it, like it's because they want to sell policies. They want to make the products look attractive. The good news is that I don't want to get to the good news yet. Okay, complexity does create confusion, and I think that that's a huge problem. So we've talked about the bad, let's talk about the ugly, and then we're going to get into kind of our key lessons learned. We'll really lock in on what we need to do to make sure that any of the bad and ugly things don't happen. Because again, there's very real and strong benefits to Index Universal Life so long as I structure it in conjunction with whatever my desired outcome is. For most people, that's going to be maximizing cash value for retirement income and then eventually estate planning and things like that. Okay, here's the real problem. This is more of an agent issue than a insurance issue, but the ugly policies sold as stock market replacements. Okay, so if anybody tells you, whether it's indexed universal life, whether it's indexed annuities, like the goal of that product was not designed to outperform the market, right? I get that it's attractive. Like, it's a really easy story for agents for us to tell, right? Hey, you can get all of the upside of the market, none of the downside. That in it, like, if I just kept it to that, it's like, boom, sign me up for that, right? And unfortunately, the industry as a whole, and partly because of the low barrier to entry, all you have to do to sell life insurance is have a life insurance license. You don't actually have to know it or be educated, understand the products and services. And so what ends up happening is oftentimes policies are sold like in a way that they were never designed to be sold for. But I don't know of any insurance company's literature that I've ever seen, even whether that, regardless of what marketplace they're in. Okay, I take that back. Outside of variable life, which is designed to compete with traditional market assets, but outside of variable life, I've never seen anything that suggests that index universal life or indexed annuity is designed and expected to outperform what the market does. And so if you're someone who's been sold that, well, that's a good reason to go running, right? So, but and sadly, it's happened for a lot of people. And again, I think it's the main, well, I shouldn't say main, it's one of the main two reasons that universal life has gotten a bad name. Agents sell it aggressively and it's not designed properly. Okay. Aggressive projection. Okay. I already talked about that. So I think we hit on that one. Brenyn, you hit on this one, but I want maybe just reiterate this one because I think it's important for people to understand. And it's a really easy way to delineate a good policy from a bad policy. So talk about a design that's focused on commission. Again, I know you hit on this, rather than long-term performance.
Yeah. The biggest thing is, there's so many ways to design a life insurance policy. And Christian even mentioned this earlier. There's the target premium or their minimum premium, target premium, and then they have the max overfunded.
Minimum non-MEC premium is what they call it.
Minimum non-MEC.
Like, what the heck does that mean, right?
Yeah. And between target and minimum non-MEC, you can even design it with different premiums inside of that, right? So there's so many different ways to illustrate a policy being or performing. Now, our go-to and what we do on every single policy is minimum non-MEC design, meaning we want the lowest death benefit and the maximum cash value accumulation. With that being said, what's difficult is that with the ability to design those policies, your commission or what you get paid or compensated on goes up or down depending on what that target premium is and what that death benefit is. So the higher the death benefit, the higher the target premium. And so what can be hard for some agents is looking at that and saying, oh, if I increase the death benefit by $500,000 or $1 million, that target premium doubles. All of a sudden, I am making 2 times what I would have been making if I sold it like this, right? So it's really important to find.
And by the way, it can be up to like 5 times.
Very true.
So just to keep that. So, and I'm even going to just take that a little further. When we design a policy, let's say it's $100,000 premium. Typically, about 20,000 of that is going to go to what we would call base premium or target premium, and then the additional 80,000 is going to go to either the overfund or the paid up additions, right? And the difference between selling the minimum non-MEC and just selling a policy for maximum death benefit in that situation is literally 5x the compensation, making say 15 or 20 grand versus making 100 grand. So there is absolutely, this should be in the ugly. There is motivation, and not always good motivations, but there's motivations at times for agents who are taking a short-term view to potentially jack up their commission and because they're trying to make it in the industry or things like that. Sorry, I didn't mean to go off on a tangent, but yeah.
Well, and I think that's it. The main thing is make sure that the policies are designed for high cash value, what you want, and don't be afraid to ask. Right? Don't be afraid to challenge or ask, because it's really easy to walk somebody through how a policy is designed for maximum cash value, high cash value. And so literally just make sure if you're working with somebody other than us, and you can still ask us, right? But just make sure to ask the questions. Don't hesitate, because really easy to explain and show people that. And you want to make sure, that it's a lot of money you're putting into a policy. So it's an important thing.
Yeah. So it needs to be done right?
Yeah.
Like totally understandable. We don't want to be ending up in a Kyle Busch situation. The good news is if you're working with people who know what they're doing, you'll never have to worry about that. But I say that also realizing that you have to understand it well enough to even learn and know who to trust and what are the signs of good strategy, good design versus what are the signs of bad. And that's kind of what we're trying to pull out in today's pod. Okay. I want to hit on just the poor explanation of flexible premiums, because I think this is, and I hit on it a little bit earlier, but basically people sometimes get the idea that it doesn't matter how much they fund one year to another, right? It's not. So while there is flexibility and I can fund more or less, it's designed to be a range of premiums that I can put into it. But what oftentimes doesn't happen is people don't understand the impact of the amount of money that I'm putting into it. So to our earlier point, if we design it for that minimum, or I'm putting in the minimum premium, there is no way by putting in the minimum premium, the policy is going to run till you're 100 years old or 120 years old, like they're designed to today. It's going to be, it's going to probably go for like 20 years. It's going to be an expensive term policy, right? So the policy just absolutely has to be done the right way. Okay. Let's finish this off and get into kind of our key lessons learned. So Blake, kick us off. What are the key lessons that you take away from this conversation?
That hopefully you've heard us hit on this 15 times, which we have, but the way that the policies are set up is the most important piece. And this can be the same product. It can be with the same company. You can still design the policy. You need to be working with agents who know how to do it. If you're going to a financial advisor who does a lot of other things, I'm not saying they won't know, but there's a good chance that they don't know how to design the policies in an optimal way to create cash value. And then secondly, knowing that especially in the early years, front loading and max funding these policies make a dramatic difference in how the cash value and how long the policy stays in force is going to happen. So for example, if someone's saying, hey, I like this, let's say our funding range on this policy is 20,000 to 100,000. They're like, well, I feel pretty comfortable. I can put in 50,000 for the first couple of years. It's like, okay, yes, you're within that window, but it's actually going to be in your benefit if we make the max on that policy 50,000. So a range of like 10,000 to 50,000. That way we're hitting the cap each year. And then a couple of years from now, if you think you want to be able to put in 100, well, at that point, we'll look to add another policy at that time.
Yeah.
So it's very routinely, certainly I'm doing this. I know we're all doing this, where we want to design the policy where you feel very comfortable you can hit those maxes, knowing that there is flexibility if something, changes in life. But we don't want to ever just project that life's going to go great and more money is going to be coming in. You're going to have more capital to put into those.
Yeah, it's a good point, because that's a quick way to be really ticked off at what happens. So to your point, if in that exact example, if I put in 50,000 for a couple of years, but then something changes in my world and I can't pay those premiums at all anymore. Well, now I'm in a more, like, my policy will still run for several years and stuff. And it's not like all is lost. I could pull it out or whatever, but I'm probably going to end up not feeling great about the overall result of the policy. Whereas if I get in the max amount, those first 2 or 3 years, especially, suddenly the policy can just run and do its thing. And you really do gain the kind of flexibility where you can determine year in and year out how much money you want to put toward it. So that's a big deal. Brennan, what are your key takeaways?
More of the same. Design, design, design. I think the only thing that I would add to what Blake said is, don't let your preconceived notions or past experiences with something deter you from potentially looking at it again in a new light. So I know there's things out there, and really there's things out there about all types of life insurance. But if you have questions, feel free to reach out. We're educational based. We're happy to show you how they work, help you understand it. Even if it's not the right time now, we're more than happy to show you it, teach you how it works. And then you at least know, hey, now I've got an understanding of it. So when the right time does come up, all right, now I'm ready to go. I feel comfortable with it.
Okay, I'm just going to give my 2 cents and then we'll take off. 2 cents on the things are like my key takeaways. Number 1, design absolutely matters way more than the product, right? The product can be whole life. It can be universal life. If it's designed poorly, you're going to get a bad result. If it's designed well, if it's designed for max cash, you're going to get a really good result. So that's, I think, an important thing. And then the other thing I just want to emphasize is it's just this idea that just like leverage, it's neither good nor bad. Life insurance all has a purpose, and I can ultimately determine what that purpose is. And I just have to make sure that my funding, my structure, my design, I know design, my design has to fit the actual result that I'm looking for. Okay. Any final thoughts from you guys? Did we cover everything? It feels like we covered it all, right? Okay. Thanks everybody for listening, and we will see you next week.
Thanks for listening to the Money Insights podcast. To stay connected and get access inside our community, you can join the Investment Insider series at www.moneyinsightsgroup.com/insideraccess.